The Inflation Reduction Act of 2022. There are some things that people are missing, and we're going to share the truth about the Inflation Reduction Act and how it can potentially impact your investment accounts in 2023. I want to start right here with the summary that was put out by the government. The Inflation Reduction Act of 2022 updated on August 11th, 2022. Now, of course, they have this top line estimates, and it's broken down by the total revenue raised. But I really want to point our attention to how this is going to impact the overall investment account. So if you hold investments in a taxable brokerage account, which typically means anything outside of a retirement account, 403b or 401k, this could be an interesting thing, and it'll be very, very interesting on what US publicly traded companies do as a result of this new excise tax being placed on them as a result of this particular bill. It is right here, the 1% stock buyback fee, estimating $74 billion of added tax revenue for the government based on this particular thing. Now, what the 1% stock buyback fee is that anytime a company goes out and they buy back more of the outstanding shares that will ultimately help the earnings per share for us investors, they're going to get hit with a new 1% excise tax fee as a result of their buyback. Now, it doesn't matter if they're losing money or earning money. Anytime they decide to buy back shares, they got to pay this 1% tax. And this starts in 2023. So I would anticipate a lot of companies may actually overindulge in some of the stock buybacks, especially those that have the funds to be able to do so in 2022. We're going to see a very good rise all the way through to December 22 until this new tax goes into play. Now, what does this mean for some of my favorite companies such as Apple? Well, check out this article right here from Seeking Alpha. Will the stock buyback tax hurt Apple shareholders? Now, Apple has a history of buying back shares significantly, and this article goes into some very interesting logic and some very good points when it comes down to this overall excise tax fee. Now, you might be asking, well, what actually is a stock buyback, and why does that matter to me as an investor? Well, let's say you buy fictional company ABC, and you're going to buy one share of ABC, and they have a total of 10 shares outstanding. So you own one share, they have 10 shares outstanding, which that means that you own 10% of the company. Now you decide you're not going to buy any more shares. You're just going to hold on to your one share of the company, but then the company decides they're going to flood more shares into the market. Now their outstanding shares are 100 total shares. And you still own your one share, which means now instead of owning 10% of the company, you only own 1% of the company. And that dilution of shares can often have a negative impact on the share price as well as the earnings per share on your particular investment. That's not good for investors to have a total flood of additional outstanding shares. That's why when we analyze stocks here on the channel, we like to see companies that are buying back and reducing their overall outstanding shares. Apple is a great example of somebody that goes the other way, where they're going from 100 down to 10, which that improves their earnings per share. It sometimes will also improve their share price and be a great benefit for us, the shareholders. But now that they're going to be hit with an additional 1% excise tax as a result of buying back shares, what are they going to do? Not just Apple, but really any type of company. This is going to be very interesting in 23 and could be an interesting trend that we got to follow as investors. Let's check out and go back to the Seeking Alpha article. I'm going to scroll down here to where it's really, really important. As you can see right here, number one, it says the company increases its earnings per share by reducing the numbers of shares outstanding. The lower price to earnings ratio drives up the stock price. In short, it makes the company's results look great and gives us, the investors, a bigger piece of the pie, just like I shared earlier. Stock buybacks also have massive tax advantages for shareholders that have their investments in taxable brokerage accounts. So talk about it from this perspective. If you get a qualified dividend, so let's say you're a big dividend investor and you go out on your taxable brokerage accounts, you could get long-term or even short-term capital gains tax rates. Could be 0, 15, or 20%, depends on your personal tax bracket. But by shielding investors, by using the extra cash, not for a dividend, but for buybacks of shares, they give us the chance to get more money by earnings per shares instead of paying us a dividend. So that way we don't have to deal with the taxes. They shield us from the taxes. But now, what will they do with this new excise tax that starts in 2023? Well, if they're going to be taxed 1%, you can see right here, the new tax will cost Apple about $860 million annually in tax at the current pace of buybacks. If they continue to buy back at the current rate that they're doing right now, they're going to be paying an extra $860 million. Are they going to want to do that? Well, if you look at their current dividend rate, well, that's a pretty low number. Typically, I like to look for dividends at like 2, 3, 4%. But because they're only at 0.63% right now, they may decide instead of buying back shares, let's go ahead and increase our dividend amount. Well, you know what they're doing, right? That means that they're taking this 1% excise tax fee. They're saying, no, we're not going to worry about that. We're not going to buy back any shares. We'll just go ahead and issue a higher dividend, thus passing the tax burden on to you, the investor. Now, the article goes on to say, what options does Apple have? Well, they can do a couple things. First thing, they can significantly accelerate the buybacks through the end of 2022, because like I said earlier, it doesn't take place until 2023. So that could be good news, and we could see that not just in Apple, but in other companies. Next, they could simply repurchase 99% of the planned amount and use the 1% saved to pay the tax. I think that would be a great plan if cash flow is the chief concern, but it will still hurt net income and earnings per share slightly. So companies are gonna have to be very careful about that, especially if they're not a big dog like Apple. They gotta be very careful about the fact that if they're just gonna reduce their overall buybacks to make sure that they cover enough for the taxes, will that impact their earnings per share and send some of this stuff into a little bit of a tailwind? And as I mentioned earlier, the third thing is they could increase the dividend and lower their buybacks. This would lower the company's tax burden, pass on the tax burden to you, the shareholder, but unfortunately the EPS will still be affected. So now I have a question for you, and that question is, do you think that as a result of this new excise tax, will companies decide not to do that and find other alternatives to reward their shareholders, such as increasing the dividend or some other means of doing that to avoid the 1% tax? Comment down below and let me know what your thoughts are on this matter. But in any case, here's my personal thought. I have no idea. It's not financial advice, it's just my guess. My guess would be, I bet companies, just like Seeking Alpha mentioned, are gonna go on a stock buyback spree through the rest of 2022. At the start of 23, I could see them pulling back and finding other alternatives. Even though the dividends would be nice, it could be a big hit for those of us who hold a lot of those particular shares in a taxable brokerage account, which means we're gonna have higher taxes if they increase their dividends significantly, but we'll have to see what happens. Let me know what your thoughts are down in the comments. Until next time, make sure you check out this video next. We'll see you on the next video.